All right, we're live. This is the July 41st episode of the monthly market update, which your friends here, the Real Estate Brothers, Lane Kawako, myself, Dean Nuera, and here we go.
In Hawaii, there's so much to do. There's hula, there's surfing, and real estate too. We just two local guys with so much to say. So listen to the Real Estate Braddahs today.
All right, so we start off with the Easter egg here for you guys. If you guys got vaccinated, I guess there's a little Hawaii lottery that you can win some free stuff. If you guys have gotten vaccinated, you guys can email me at lane@simplepassivecashflow with the subject line F COVID, and I'll give you the free remote investor e-course light version. And if you haven't yet, go to that Hawaii Got Vaccinated website, and then you can win some free stuff there too.
Yeah, so wow, Lane, episode 41. We're not getting any younger, and we've been through quite a few of these. And I was gonna suggest maybe because we're not getting younger, and also for you, we could also transition to the real estate fathers.
Oh,
So to take the chance to say congratulations to you on being a father, dude.
yeah. We got young Kira was born a few weeks ago, and then one of the investors said, "Kira, like IRA, Kira?" And I was like, "Yeah." So then I went to the
Oh,
wife, and I was like, "Did you know there was IRA in the thing?" And she was like, "Oh, geez, not again." But anyway,
you're the IRA Kira.
yeah.
Anyways, yeah, so why don't we jump in? So today's July 1st, so just the beginning of the New Year. Statistics for June is not going to come out for another 5 days, but we'll call it the Nostradamus prediction again that we're going to have new records being broken, but actually not really. I think um, some statistical information that I preliminarily pulled. It looks like um, for single family homes for June, we might possibly break a new record. So if you guys recall, last month for May, the median single family price for Oahu was 978,000. So for June, we might just break the record by 1,000 possibly, and we might be in at 979. In any regards, it's still trending upwards is kind of the point. And if you compare it to same time last year, June 2020, there's a difference. Was 772.5 was the median price a year ago. And then again, as we mentioned before, keeping in everything in perspective, that was in the heat of COVID, right? So that's what caused this big jump from prior year. Condo townhouse median prices are probably gonna be just about the same. I think for May it was 457.5 and some change, right? So I think it's gonna probably be around the same for June, and then compared to prior year which was 420,000. So nothing new. Things seem to be trending up, and as I like to do, not pay a particular attention to the exact numbers, but just look at the lines and the diagram. So the new listing trends on the right side is looking a little better because, as you can see, there's a little uptick at the tail end here for the last 2 months. So for both single family and condo townhouses, we have a little bit of uptick in terms of new listings popping up compared to a month before. So we have 471 new listings for single family and 769 for condo townhouses for the month of June. But then again, on the bad news, we see homes for sale. We see it's kind of looks like hopefully it might be bottoming out in terms of how much inventory we actually do have. So you can see it's kind of going down, or hopefully leveling off in terms of what's available. Yeah. Um, the big one, month's supply of inventory. So again, as we mentioned before, this is if we were to have no new homes pop up on um, for sale, how long would the current existing available inventory last before it's all gone and sold off? So for single family, we have 1.1 months of inventory, and condo townhouses 2 months, which are extremely low. And again, story hasn't changed for a while now. It's strong sellers market. One interesting thing I saw was for the median percent of list price. So this is what, compared to list price, what the house actually sells for. So this data from InfoSparks goes back to January 2005. And as you can see, only in the last only in this year, actually, we've actually seen single family jump over 100%, which is interesting because, if you're someone in the market putting in offers in single family homes, you're often seeing it go over over asking price 50,000, maybe 100,000. So, but according to InfoSparks, only in January of 2021 and June have we seen or any um, prices go over the list price for median prices. So I thought that was kind of interesting. What it means, I'm not too sure, but it's kind of weird because since 2005, it's never gone over 100%, which is really interesting. I thought it would have been a lot more, especially in the last 2 years. But we'll see. I have no opinion on what that means. I'm still trying to figure it out myself. So
the list price, I mean, it's kind of arbitrary, right? I mean,
that's a very good point, Lane. That's a very good point. Like as realtors, we're trying to provide comparables to our clients to, and it's based on historical, what's available and also what's closed and what's pending. So and it's up to the seller or the owner to determine what they want to, if they want to price aggressively or if they want to list to sell, or if they want to try to break some new records. Oftentimes, to your point, Lane, it's arbitrary, and you put it out there, and because it's so hot, the market decides what the price is going to sell at. Yeah.
But if I was a realtor and I was just out for like padding my stats, I'd like list a home for $1 just to see what happens, and then just do one of those per year, and then I can tell everybody like, oh, I'm hitting like 120% of like offer to list price.
Oh yeah. Realtors do all the time. Oh, we just sold at $100,000 over asking price, right? So that's
because you idiots put it $100,000 too little bit, right?
No, honestly though, for single family, it is kind of crazy. It's off the hook, and we've priced. I've been on both sides of the tail where we've priced what we thought was aggressive, and then we were getting still 80,000 over asking, and it's not like there's no comps that would have supported that, but it's the market is just crazy, and there's been other times where we thought we priced it conservatively, and then it sits for a bit. So to your point, Lane, it is arbitrary, and the market will determine what the price will sell at. Yeah. So I figured let's talk about some tips for our buyers as well as our sellers. So we're starting off with our buyers, and so this is information or tips that actually should be coming from your lender when you're buying. Here's 4 mistakes that buyers make while they're in escrow. So, or even before that, right? So number 1 is not checking your credit report regularly. So the statistic is that 34% of Americans have errors on their credit reports. So, it's something you should request annually, review it, and see if there's anything that should be contested, removed, or anything like that. Another mistake is not being honest on the application. Like the whole drill is that your lenders, underwriters are going to be digging in to corroborate what you're putting on the application, so it doesn't does it make sense to put anything that, even a little, what you think might be a little white lie, it could end up throwing everything off. So I would say, just be honest. It doesn't make sense to fib on it. Yeah. Another mistake, and this is a little bit hard, but try not to take a new job while you're in escrow. This may not typically be a deal breaker per se, but it could slow things down. And I say this is hard because in current times, depending on your industry, this may be something you can't control. So as much as possible, try not to be transitioning to different jobs while you're in this buying process. And if you do, again, be upfront with your lender and just tell them as soon as it's happening or if it's happening. Another thing is, talk to your lender and ask them, oh, what if I do this, right? Will this have any effect? A lot of buyers, while they're in escrow, they're like, oh, we're getting a new house. Let's go shopping for furniture. And where does it go? On your credit card, right? Or even worse, you buy a car and you take a loan out, and that's going to affect your credit. So making major purchases while you're in escrow is a no-no too. Again, it may not be a deal breaker, but it could be, and it could also slow down the process and the time frame that you close. So it could throw kinks. Worst case scenario, you won't qualify for and get your final approval for the loan, but try to stick away from those things if you're in process. Not to say you're walking on eggshells, but just be cognizant of what can affect your credit while you're still in escrow.
Yeah. So some other best practices, like be careful of any kind of transactions bigger than a third or a quarter of your paycheck. Those will usually get flagged by the lender. Best case scenario, you have to write a to whom it may concern letter, which is really annoying either way.
Right.
And then best practice too is just like never email your lender if you're doing something that you think is not really questionable, but like will put a flag on some like underwriter. Like just call him up, make it informal. Hey, I know a friend, he's doing this. Will this ruin his application? Because once you put it in writing, you're screwed. I say this because I think the underwriting requirements are really dumb. Like it makes absolute no sense. If you don't have really clean financials, W-2 income, it's super hard to apply for these loans, which just dumbfounds me. It frustrates me a lot because these are people who qualify easily. But I've had it. People like were already like 3-4 weeks into a closing on a rental property, and like they changed jobs, and it would have been all fine if they wouldn't have just said they wouldn't have disclosed additional information for no reason other than disclosing it. They should have not disclosed it because they wouldn't have done anything anyway.
Right. And even now more than ever, there's additional scrutiny in terms of, okay, well, let's make sure this buyer is still employed just before we close, because with the current employment situation, you never know if especially if someone's in the tourist industry or something like that in Hawaii, you don't know what's going on. Although right now the trend is looking pretty positive for us in terms of tourism. I think we talked about some statistics last month, Lane, and then anecdotally, I don't know about you, Lane, but I went to the Prince Hotel for some sushi.
Oh, that place is good. Restaurant.
Yeah, I like it. It's a nice izakaya place. There's a sister sushi restaurant in Tokyo that it's really fun, and it's very reasonably priced. But I was talking to the valet when I was leaving, and I was like, oh, so how's things going? He's like, yeah, they've been in full swing for the last month. I think they're like at 80s 90s% in terms of occupancies, so pretty good. Positive vibes, as long as that Delta strain doesn't come upon us, right? So
no comment.
On the side for sellers now, so here's some one big issue for sellers, I mean, the way, however you look at it, it's buyers too, but it's the appraisals. And they're not coming in where we want them to, and they're coming under purchase price or agreed upon price. So things to keep in mind, whichever side you're on, is that transactions that are pending or active listings are typically not considered in the final opinion value. So you can't say, oh well, I'm in contract for $950,000, and there's another comparable 4-bedroom house. This is at 1.2. I'm golden, right? No, that's the inherent issue with appraisals. Is they look at historical closed transactions, and that's what they're basing their appraisal off of. And so that's the challenge we have in terms of trying to, especially in an upward moving market, trying to substantiate these prices that are, or these agreed upon purchase prices that are pushing the envelope on an upward moving trend. Yeah. So keep in mind, 1/4 of offer prices are higher than appraised value, meaning, 1 out of 4 times we're coming out short, right? So one way that the seller can help, or the seller that you're with assistance from your realtor, your agent, is to detail, itemize any improvements or innovations that you have and provide it to the appraiser. And if you have invoices or costs or the price that you paid to do these improvements or renovations, that also helps. It's not the silver bullet, and it might not get you up there, but it helps provide perspective to the appraiser, and if anything, it's evidence for them to substantiate a higher appraisal, right? As a realtor, I'm never afraid to talk to the appraiser. I mean, you don't want to influence them or make them think you're influencing, and every appraiser is different. Some appraisers think they're God, and in some case they are in the situation because our hands are tied. But oftentimes the appraisers are very amicable and friendly, and I'd like to talk to them, let them know about the improvements that have gone on, what makes this property more valuable than others, and how, or even why it may be perceived as less, but why it's not. So just letting them know your opinion. No, there's no harm in that, assuming that the appraiser is open to discussion and to talk about it. So, I mean, sometimes depending, I'll even provide like a packet of information. But I mean, it is what it is. They're gonna pull the comparables, and what they say goes. You can contest it on the buyer's agent can contest it, or if it's on the VA side, if it's a tidewater, then there's a process where you can appeal. But at the end of the day, you're at the whim of the appraiser. So just do what you can to increase the chances of the appraisal coming out, because it's in the benefit of both the buyer and the seller for it to come out, regardless of what I put as the 4th bullet point, which is an appraisal clause, right? So if anyone has been putting in offers recently, and to get a fighting chance, you should all know what an appraisal clause is, right? In terms of the buyer is willing to come up with the difference of the appraisal clause versus the purchase price in order to ensure that you close. So ideally on the seller side, you would want to have a buyer who submits an appraisal clause, and that they're financially able to do so if it does come out short. And on the buyer side, to increase your chances of winning in a multiple offer situation or getting your offer accepted, appraisal clauses are going to help you in the light of looking like a stronger offer for the seller. Yeah. So just a few tips. Cool things in the news. This one's more for the tenants and the landlords. I think a few months ago, we talked about the Supreme Court ruling. So this one, I think that it was appealed a few months ago. So this, I believe, should be the final verdict. That's saying that the U.S. Supreme Court has said that the CDC lacks authority to implement these nationwide eviction moratoriums, right? So according to this new finding, or what the court has said, now they're not CDC isn't allowed to do this stuff. But with that said, they weren't going to remove the ban. They were just going to let it run out, which it's supposed to run out at the end of July, which is interesting. So I think for the state of Hawaii, Governor Ige has our eviction moratorium that goes to the beginning of August. Yeah, so like August 6th or something, I think is what it is. So we'll see what happens, right? Because whenever you have a federal mandate that differs from the state, then it always gets all kind of funky like that. Yeah. So the NAR president was saying for more than a year, mom and pop property owners have been pushed toward financial ruin as they upkeep their properties and pay their taxes and mortgages with no income on their own. So again, that's coming from the landowners or landlord standpoint, right? It's hard because then when you look at it from the tenant standpoint, if they're not gainfully employed, then you're gonna what do you do? They get put out on the street and become houseless. So two sides to every coin, but I just wanted to bring up that this came out yesterday. Another fun article that came out, I just saw this one today, was in California. There's what's called the Flintstone House. So they were getting sued by the neighborhood. Again, this is in like San Fran, Northern California, and this house was considered an eyesore because of the shape, the colors, and it said Yabba Dabba Doo in the yard. There was the Flintstone gang, and there were dinosaurs, and so everyone meaning the neighbors were all complaining because they said they didn't have the permits to make this house. So it was a lawsuit from 2019, and it just got settled this spring. The owner was actually an Asian American, Ms. Fang. She's Chinese American. I think she's getting like $125,000 to cover her legal fees, and she's also needs to now retroactively permit the property, which I think, according to the settlement, once she submits it, it will be approved. But later on the next slide, you'll see some fun pictures. I was like, this might be a fun tourist attraction. There's literally dinosaurs in the yard. There's Fred, Wilma, there, and inside there's actually, it looks like a prehistoric home or like a Flintstone home. So I don't know. I don't think she lives there, and I think it's kind of like a tourist attraction. So if you guys are in that Bay Area, maybe you guys want to go take a look at that place. I think she bought it for like $2.8 million too back in 2017. So something fun in the news, I guess. And to end off my section of this month's, I wanted to talk about a fun fact. So we are halfway through 2021 officially. Today is day 182 of a 365 days. So today is the last day of the first half of 2021. Yeah. So it's a good time to look at your goals, your annual goals, your New Year's resolutions, your vision boards, to see, are you halfway at that point? And if not, how are you gonna pivot to get there? So hopefully it's more of a motivational thing for you. When I put this slide in, I was like, I better go look at my vision board to see where I am on track. So it's a good checkpoint for you, for me, and to see where you guys are at. So yep, that's what I have for my portion, Lane.
Right. So if people are interested in learning about investing on the mainland, check out my podcast, simplepassivecashflow.com. We talked a lot about investing as accredited investors, tax, legal, infinite banking, those type of topics. And iTunes, Google Play, YouTube, all of the such. And folks want to ask any live questions, type it into the chat, the comments section below. Dean will be watching those. But some teaching points before I get into the news here. Had a great couple podcasts about Bitcoin and crypto. I think people talk about crypto. There's three main ways of playing this stuff. There's the staking, where you're just kind of getting the yield on it. There's the investing in more of the blue chips ones like Bitcoin or Ethereum. And then the third one, which I think gets a little bit too much play, is the investing in the altcoins, like your Polkadots, your Dogecoin, and all these asymmetric risk type of coins. I think most people that I kind of interact with just will play around with the blue chips, these Ethereum and Bitcoin. But where do you start, right? Because I think most people who are Bitcoin crazy probably paying with more than 20-30% of their portfolio. But the people above $1 million net worth, I usually see anywhere from like 1 to 5, maybe 10% of their net worth. And here are kind of different levels here, how, from a scale to 1 to 7, how confident are you in this stuff? I'm fairly confident in it, but I don't think I personally would go higher than 5 or 7%. I don't really have anything right now. I mean, the stuff I have is pretty negligible at this point. But yeah, I think look at these top 4 guys: Warren Buffett, Jeff Bezos, Michael Bloomberg, Elon Musk. Their net worth comparing to their tax rate there on the right side. Learn to invest like an accredited investor. It's not like you're dodging taxes. You're doing your fair share of the help around here. The tax code is built to incentivize you to do certain things that the government wants. If you follow the directions, do what they say, you get to pay little to no taxes. If you're just investing in normal stuff like the average person, you got to pay anywhere from 15 to 30 something plus effective tax rate. And this is why I like real estate. Real estate has the great tax benefits, and that picture on the left is the Bitcoin miners in China. That China kind of shut it down. All these things are like not worth anything, and this is why I like real estate. It's a hard asset. It's worth something at the end of the day. It cash flows and it has great debt terms. But yeah, I'm going to try and go through the news real quick. HSBC Bank is closing. They're getting transferred over to Citizens Bank on the East Coast and Cathay Bank on the West Coast. Just a little bit of consolidation there for some banks. Zumper came up with this great report on the rent growth. This story started probably earlier this year, but I think there's no secret. Rent increases are skyrocketing at this point. If there was some doubt before, that doubt is gone. Rent for 2-bedroom apartments rose nationally by 4.8% year-over-year, with a 3% increase for 1-bedroom apartments. This includes a lot of the gateway cities and all the way across the country. Milwaukee grew 8.9% year-over-year, but dropped 5.2% month-to-month. Glendale, Arizona went up 15.7%. We're going to go into some other news sources, similar data, but just a little bit of variation too. But the story is the same. Rents are going up. Which city saw the largest swings in rent? Irving, in order 1 through 5, Irving, Texas, San Francisco, California, Madison, Wisconsin, Des Moines, Iowa, Reno, Nevada, Austin, Texas, Baltimore, Plano, Texas, Detroit, Michigan, Chandler, Arizona. Those are some of the top ones. The downward ones, Spokane, Washington slipped 5.2%, but they're still up 13.6% year-over-year. Richmond, Virginia, Durham, North Carolina, Milwaukee, Wisconsin, Boise, Idaho, all those dropped slightly, but are still up year for the year. I think a lot of people talk about Boise. I mean, that place is absolutely blown up, but what a lot of people don't realize is that's still a very small market. If a small amount of people move there, it's going to move pricing quite a bit as comparison. If 10 times of people move to a city like Houston, Texas, with I think maybe 20 times the population or 30 times the population of Boise,
Is that like a tertiary? Boise, not even.
It's a small tertiary market
Yeah.
for sure. Yeah. But I mean, they kind of went down a little bit, but that's just because probably it just blew up for the past 18 months out there. This it's a great example of headlines that make the news, but is it like long? Is it a long term kind of a thing? May or may not be. Um, Here, Real Page comes out with their statistics on annual rent change. Um, Riverside, Phoenix, Sacramento, Las Vegas, all over 10% rent changes per the year. Rounding out the others are Tampa, Memphis, Atlanta, Jacksonville, Greensboro, Salt Lake, between the 9 to 7% range. And then between 7 to 4% are Virginia Beach, West Palm Beach, Charlotte, Providence, Detroit, Baltimore, Fort Lauderdale, Indianapolis, Fort Worth, Raleigh, Durham.
13%. That's just crazy.
Yeah, that is crazy. Anything above like 3% is a sign of super healthy market.
Or hyperinflation or something.
That too, right? I mean,
Right?
it's I don't know. I mean, I would say 2/3 inflation, 1/3 just demand.
Mm-hmm.
Here's another one from Realtor.com. Riverside, that same one that they put as 13.5%. Realtor.com has them at 19.2% year-over-year rent growth. Memphis at 17%, Tampa at 16%, Phoenix 16.8%, Sacramento 15.8%. I know you got. Actually, I'm a Las Vegas investor now myself.
Yep.
Yeah, 12.2%. Here we go, buddy.
I love it. When are we going, Lane?
I don't know, man. Maybe next year. Here's another. I don't know. What is your thoughts on this? Like this article, home affordability declines, right? Because prices are going up. That also has to do part of this, right? As people are unable to afford houses, where do they go? Well, they go and rent apartments to live in.
Yeah. And that's that right to your point is also driving up, which is so interesting, right? Because interest rates have gone down so low, and it like here they're the buying power has gone up so much, but in Hawaii, that especially for single family, inventory is so low that these bidding wars are crazy. I heard one property in Eva Beach had 60 offers on it, so it's like, man, I mean, there's so many different moving parts that affect, right, the sales side, and then now you're looking at the rental side, and like to your point, Lane, rentals are going up. So I have sellers too who are looking either to upsize or downsize or just buy somewhere replacement properties, and that's rough. And then they say, okay, what if we go rent? And then they're looking at rentals. It's like, even that's pretty tough. So yeah, it's like it's creating this crazy issue for all. And and we always talk about the cost of lumber going up too, right? And all of these different moving parts affecting, right? And so that's why it's cool that you're apprised of all these different things, because to me that's value.
Lumber actually went down though the last few weeks. Yeah.
Last few weeks. Got it.
Yeah. It actually is, and they say it's going to be around there. But exactly to your point, for people who aren't like kind of too tied into how this works, like interest rates go down so people can afford more, which if you ask me is kind of dumb. They should afford it anyway, right? Just because you can qualify for more debt doesn't mean you should go and buy a bigger house. But anyway, I'm not their parents, right? They can make their own choices. But most people will go and buy a bigger house, and that's what pushes the prices higher, because people can afford it. But the question is, well, at what point does the interest rates go lower and borrowing affordability go higher, and they can afford more to a point where people are just stretched too damn much, right? What is the limit? Did they get maxed out on the jumbo loan, or their constraints on debt service coverage ratio? And I think that's the point we're getting to, right? We're testing that. How high can it go so people can't afford the thing? It's just like rents, right? Like in Dallas, Texas, back in the day, the mid 2000 or 2010s, you could like rent an apartment, a 1 bedroom, 2 bedroom for $900. Today, that same thing is $1,600 a month, and the thing keeps going higher and higher and higher. When can that person making 40 grand a year not afford the 1,600, the 1,700, the $1,800 a month apartment? It just keeps going and going and going.
Yeah, economics gets all jacked up.
Yeah, I mean, especially with the home buying, because the home buying is like you can fake your way to getting a bigger house, but with renting per month, that's why I like to go off this metric. What are the rent increases doing? Because that is going off of people who aren't fudging the numbers with financing. If you don't make a certain amount per month, you can't afford. I mean, usually the rule of thumb is like 1/3 of your income goes to your rent. You can't fudge that. You're not going to borrow that.
And so theoretically, all of these forecasted rent increases, for all intents and purposes, for like say the syndications, it's just bumping up the exit price, right, in terms of the fair market value that it's going to sell for in the future.
Right. I mean, but people do it all different ways, right? Some people assume that their rents are going to go up 5%, which to me is wishful thinking. But hey, however you want to run your numbers, you're just going to be screwed over when it doesn't. But yeah, like if it goes higher, then it's all gravy at that point, or it makes up for other mistakes along the way. Mm-hmm. But yeah, these are all like real numbers. Like Memphis going up 17%, Phoenix going up 16.8%. I mean, I do think like a lot of these places, they went down maybe a few percent points in the pandemic, potentially. So, you could probably deduct that off of this, but that's still a pretty high rent growth for a 2-year period.
And so then, so like you said, that question that begs me to think too, if it's rent year over year, is this data skewed from the standpoint of was the rent reduced at the heat of COVID, and so then is this like now a correction back up to what's the pre-COVID numbers again? I guess that's
probably, you know how news is, right? They're always trying to make a bigger number. So like I think this realtor.com is doing exactly right. They're going from the trough and measuring to now. That's how they're getting these really video game kind of numbers. I think this is more realistic. Year 7. To me, like I know Phoenix, like before the pandemic, I mean, it was going up anywhere from 4 to 6%. That to me is super high. That's like anything above 6% is just unheard of. But this is the bounce back, right?
Right. And what to your point too, at least we see consistency in what's going up. So I guess it almost corroborates each other, but which one you want to pick, probably the more conservative one, right?
Yeah, I think the takeaway is just the relative rankings, right?
Yep.
So I do some office. This is kind of an article talking about from Commercial Property Executive, rising sublease rates boost office occupancy. So what they're doing there is like some of the bigger tenants, like a JP Morgan or Experience, like the bigger offices, they'll kind of eat up space left by other folks behind. And again, it's just like another case of like the strong get stronger, the weak get blown out. Right? But here, like Wash Reed is, I guess, a big kind of like a Blackstone or a Sam Zell kind of character. Like they agreed to sell. They sold off their office portfolio, $760 million, and they're shifting their focus to multifamily, probably because of the more recession-proof nature of the asset class. Performed through markets acquisition in the Southeast market to reduce its leverage by repaying outstanding debt. So that's what the big players are doing, and also Blackstone bets $6 billion on shifting path to suburban homes. So they're going after single-family homes, 17,000 homes. No different. I think they did this post-recession too.
It's just That wash REIT one is kind of interesting because it's like, and I'm not a commercial dude or retail by any means, but it feels like you're agreeing to it now, and you're selling at the low. Wouldn't you want to? You don't want to sell low, right? I don't know, and buying high.
Yeah, but then again, it's like, every day you don't sell it, you've chosen to buy it, right?
Right.
So people sit on like losers all day long, and if you haven't sold, you've agreed to, you're a buyer, you're long
Right.
the position.
Right.
So, I think these are the pros investing here, right? They're not like some amateurs who got their ego wrapped up. Oh, I don't want to cement a loss. I'm underwater with my house. I don't want to cement the loss. I'm going to write it up, even if it takes 50 years. These are the pros. Don't do that type of stuff. They don't get emotion involved.
Yeah, good point.
But it's interesting. The thing is, like, these big groups, they have trouble getting in the weeds and managing these 17,000 homes. It's a problem. So this is a graph of what's been happening from the lending perspective. So it's kind of hard to see here. It's kind of small, but the blue tip is your HELOCs, your greens are your refinances, and your purchases are the dark blue. So the purchases have kind of been slightly going up, but the thing that's been jumping up lately is the green one, which represents the refinances these last 3 quarters. So that's what a lot of people are doing these days, probably because of the lower interest rates and they want to stay put.
Yep.
At this point.
Yep. I'm in the green actually too.
Yeah. We're refinancing a lot of the multifamily stuff right now.
Yep.
And a lot of the COVID reserves are going away now.
Yep.
What they're saying. The pandemic is over. And as we said before, right? The CDC. Oh yeah, here it is. Here it is, right? Just as you're talking about it. And you had this article too before, right?
Yeah.
The CDC moratorium is kind of going away. Let's not argue if it was constitutional or if they had jurisdiction or not, because that's a waste of time. But like, what's happening when it does go away, right? When people don't have that protection that they can't get evicted. Obviously, we try and invest in more red states where people don't pay. We still evict them. We find a way to evict them. There are means to evict them, as opposed to other states where it takes an act of God to rightfully evict somebody. So there's the forbearance program going to be burning up, and then the July 31st is the moratorium rents. I don't know. We'll see what happens, right?
Right.
Some people, I had George Newberry on the podcast, and he's a big single-family home investor. I think it's very different than the large apartments and office, commercial, retail, but residential real estate, which are like 1 to 4 units, I do think that you're going to see a lot of foreclosures. I don't know if that's going to cool off pricing. I don't think it'll impact Hawaii, but I think on the mainland, you're going to see the prices come back down.
Mm-hmm. Kind of interesting. My CPA had mentioned that kind of related but unrelated, that the AICPA reported that and we didn't have any of this in the news articles, but the AICPA reported that government spent up to date 14 billion, I believe, on COVID relief related expenditures. So I was like, wow, that's a lot of money. We talked about the inflation and rents going up, property values going up. So and all the moving parts, right? So that's just another moving part in terms of Fed spending and keeping the rates down, right? So I think, and the latest word on the street is that the Feds are going to keep the rates at low through 2022 and may start increasing rates in 2023. I don't know if I think that was last week.
I think I've heard that same tune. too.
It affected the stock market, I think, when the Feds announced or kind of implied that, because I think they thought it would be later. So then I think the markets took a little bit of a hiccup that day.
Yeah, but then the jobless claims kind of came
Went
out. You know,
down.
people always forget
Yeah,
after a couple of days, but the
Right.
jobless claims came out, and things are looking pretty decent.
Positive. Yeah.
Yeah.
Right. Yeah.
I don't know, man. I mean, my opinion, like, I think we're ready for, like, people are gonna make a lot of money, legacy wealth in the next few years.
Agreed. Get your dry powder ready, or start.
Yeah, get your lobster chaps out there, get it working.
Yep.
If not,
Exactly.
you're gonna be one of those, like, guys who are just complaining and say, you know, it's just, I didn't was so comfortable, you know. But anyway, like, so Arbor came out with this little graph that I thought was kind of interesting. It kind of broke down, well, who owns all these assets out there, right? So single-family homes are primarily 70% are owned by individuals, which I call mom and pop investors or unsophisticated folks. So when Blackstone comes out and buys 17,000 properties, that's just a drop in the bucket, right? But that would probably fit in this little 1% of institutional managers, the light green here. 1, 2 to 4 units are still very similar, your mom and pop investors. But your multifamilies are pretty much owned by institutional, or I think I would just call this 60% are owned by LPs, LLCs, so small groups or larger, more sophisticated investors. You don't have the mom and pop investors, about 10% there.
Oh.
So here's kind of like your pricing on residential homes. So your red is your high end. The high end is spiked, probably because, like, I mean, for those of folks who make a good salary out there, white collar professionals, you probably were very unimpacted by the pandemic, especially if you're unable to hold on to your job and work from home. You have more money to spend because you're not able to spend it. Prices for high end homes have gone up. If you notice, there is a little bit of inverse between the affordable homes, which is the turquoise color here, has spiked and got even higher, relatively speaking, than the mid-price homes. So that kind of tells you something, right? Like, it's the low-end stuff is what more demand for.
All right. Interesting though how it all pretty much moves in unison. There's a difference, and the gap is between the high end, like Lane, you said, there's a gap, in the high end compared to the affordable and the mid, and the mid and the affordable are pretty close.
Yeah, I mean, in the recession, this was the opposite, right? Your high end was, I think, kind of getting wiped out, if I recall. I guess everybody got wiped out.
Yeah.
And then you had a image on this on, like, the Hawaii demand.
Mm-hmm.
So this is days on market, which is indicative of the demand and supply out there, I guess. But this is kind of your hotness of your market, your market. What is the seller's market defined as? Like 60 days or more?
Yeah.
So we are in a seller's market.
Yeah. We do have a comment from anonymous Facebook user, or a question before we end. So this says, pre-IPOs have been more accessible than in previous decades. Are they worth getting into? Lane, I'll let you.
I'll let you answer. I don't know. I mean, I don't invest in stocks. I think it's all fake money. So
yeah, I mean, back in the the .com boom, I think that was a whole different story. And when I was kind of getting into it, but to your point, Lane, I haven't really been following the IPO, the wave, and trying to jump in on something. And I kind of look at it, it's almost like trying to jump in on something with baked in equity or something like that, but it's even more risky from the standpoint of, value add plays that we do, or properties that we're getting off market that have baked in equity, it feels like you can really determine that, and there's a lot of more calculated risk than these pre-IPOs where you're not sure where it's gonna be when it actually goes IPO. So I can't comment on that with any type of knowledge, I guess you could say.
I did a little bit of research, nothing in the last month, but the past maybe few months, I did a little mini dive into like tech startups, which I kind of fit in this realm of asymmetric risk type of opportunities.
Okay.
I discovered that like, yeah, you can make a boatload of money, but your batting average is going to be like, I don't know, like one out of 30 or 50, you might, 10x, 20x your money.
Yeah.
So what I'm going for as an investor is like, I want a higher hit rate. I'm okay making little singles and base hits here or there. I want my weighted average to be higher and more predictable than waiting on like a shooting star, 1 out of 40 deals I invest in.
So basically reduce that risk return tolerance and bring that down, right? Because to your point, Lena, when we have a bigger nest egg to play with, and we want to do like, we don't want to lose principal, right? I mean, that's the biggest thing that's going to hurt.
Capital preservation. I mean, I just want more. To me, it's more what is the average return, right? If I invest $1 million in 20 deals and only one does decent or good, what is the average of the whole $1 million portfolio with 95% of it just that went to zero? As opposed to I just would have invested into 20 stabilized, cash flowing real estate, hard asset deals, very lower risk, lower moderate returns, lower risk, right? Like to me, I think that's, I mean, it's a numbers thing, right? Well, what's my average return going to be?
Yeah.
Something I've realized by interacting with people in the space is a lot of it is just like really rich people. They're just bored, quite frankly, is what I kind of discovered. And this is where I kind of backed off because I realized a lot of these guys knew nothing about the technology or the business or the operators. And I started to realize I was in a dumb person's sport. And that way I realized it was kind of a sucker play. When the average returns are less than something that's more predictable and prudent, like real estate. Yeah. But who knows? If I was worth $50 million, I'd be investing in IPOs all the time because I don't care, right? But that said, most people listening aren't worth $5 million or greater, right? You guys have to prudently build your wealth, and I think that's with cash flowing real estate or things that are hard assets.
Yeah. So sorry, Facebook user, we don't really have a educated answer for you.
Yeah, sorry, we're a different channel probably.
Yeah, we're not the pre-IPO Braddahs. But thanks for the question though. Thank you for tuning in and asking that question though. Appreciate that.
But it's a very valid question, and I think it brings up a point that it's like the pre-IPO or like altcoins, right, for Bitcoin, which are essentially like tech startups.
Comparable. Yeah, like, agreed.
And that's what frustrates me with the altcoins. Like tech startups only they restricted a lot to like accredited investors to that stuff. But for some reason in an altcoin, which is a tech startup, anybody, any Joe Blow can go buy it, which is very dangerous. And I'm all for non-accredited investors investing in good deals. But like with like a lot of these altcoins, like it's just, they call them S coins for a reason, right? It's just garbage a lot of times, but they have access to it. And I think people invest off like ego on what looks cool. And I think IPOs definitely fall in the sexy type of.
Yeah. Real estate is not sexy. That's for sure.
Yeah. It's boring. It's like blue overalls and hard work, and it takes a long time.
Yeah. Unless we go to Vegas, then real estate might be sexy. We got to go to Vegas.
Yeah, which is kind of funny. You're just going to go to some boring rental and there's nothing to do. And then you're like, all right, what's for lunch before we go do something later on, right? That's But but anyway, if people want to build up their community with more accredited investors, check out the Family Office on a Mastermind, simplepassivecashflow.com/journey. This is like a classic question that comes up, right? Like, well, what's a good profit projection split? And people in my family office group, right, they know, like, it's nothing to do with, like, is it a 90-10, 80-20 split? It's all, what are the assumptions of the deal, and is it a good deal first, right? Because who cares if you get 99% of a crap deal that doesn't make any money, right? You're probably better off being in a 50-50 split deal that's actually a strong deal that's underwritten properly. But if nobody's got any questions, type it into the comments box. We'll wrap this up. Any last comments there for the group, Dean?
No, just now, like you said, we're halfway through the year. Now is a good time to reflect on what happened in the first half and look forward to the second half.
Yes, that is always the wake up call, right? It's like, oh shoot, it is July 2020. No, July 2022, right? Or 2021. It's a time to get working. What is something that you drop the ball on and you're gonna pick up second half of the year?
Me?
Yeah.
So unwork related. Well, work related. I think we talked about my team in trying to get a VA, get some virtual assistant and leverage off of that. On the non business related, my son is getting into tennis and he's getting very serious. I think he's getting serious. So I'm actually getting into tennis myself. So I joined. Gonna start playing in like a league that starts up in August, and I've been trying to get a little bit serious in terms of getting reps. Even watching some Wimbledon going on right now.
I want to play tennis too.
Let's do it, man.
Yeah. Can you find me a coach that will hit me balls for
Yeah.
I'm not very good, so he doesn't need to be that great of a coach.
Or I was gonna buy a ball machine, so maybe I'll just buy one of those and you can just use it.
Oh, okay.
Yeah.
Yeah,
So,
that would have been really good.
Yeah.
Newtown, their driving range is reopening, so.
Oh, cool.
If you want to just smash some balls, that's
Dude,
another way. But that tennis. How much is that tennis ball machine?
I think it's under $1,000. It's like, I think 700 something without the balls, but if you buy the alternator with it has like special balls, it may be like a little over $900 or something like that.
Yeah. Did you see the bog shagger that they also have? It looks like a little Roomba.
Is that the one that it looks like a bingo thing? Not that one.
No, it crawls the tennis court and it
rolls. Like automatic, like a Roomba.
A Roomba.
Oh my gosh! No, I didn't see it.
Yeah.
How much do those cost?
Anything worth it these days is $1,000, right? I'm just guessing. You don't get any good toys for less than that.
One of us hit, the other one shag. We'll be good. We'll just get the machine.
Yeah. All right. Well, all right, everybody. We'll see you guys next time.
See ya.
Free real estate investing group, check out reialoha.com.
We're just two local